Hi, I'm Paul Carroll. I'm the editor-in-chief at Insurance Thought Leadership. I'm delighted to be joined here today by Thierry Léger, who is the Group Chief Underwriting Officer at Swiss Re. We're doing a series of these interviews just to probe a bit and follow up on the recent International Insurance Society Global Insurance Forum. So Thierry, welcome. I'm delighted to get a chance to chat a little bit.
It's my pleasure, Paul.
To start with a somewhat personal question, I think about the theme, the Great Reset for the forum, and we talked about all sorts of things going in. We've had all sorts of inflation added on top of that, the Russian invasion of Ukraine and so forth. And then I think of you as an underwriter, and basically you just have to figure it all out, right? You have to not only figure out what's going on today, but be able to look some years into the future and say, well, all right, the next invasion will happen here. The next hurricane will happen here or whatever. So just to probe a little bit, what's it like to be an underwriting officer in this day and age? And what are the big concerns that you have?
I really think two things actually go through my mind. So what is it for me to be a chief underwriting officer in these times is that I feel in the 25 years I have been in the industry, I have never seen so many crises coming together at the same time. I mean, we all know about climate change going on for a while. We had COVID and we had supply chain disruption going on during COVID already. This has been exacerbated, obviously, by the war in the Ukraine. The war in the Ukraine has exacerbated other elements, so it led to a food crisis, energy crisis. So just the number of crises is quite mind-boggling. And the second element that does strike me these times is when I think back, I haven't lived then, but let's go 500 years back. When you were born, you could look at the life of your parents and you could be pretty certain that your life will be very similar. When I look at when I started in the industry, we had a pretty good view of what's going to happen the next 10 years, looking back 10 years. This has changed. I think the observation period has become much smaller. So we now go back 2-3 years, and it still is not a good guess of what's going to come in the next 2-3 years. Now, in underwriting, the privilege we are having, because we are not magicians, as you present us, Paul, unfortunately. So we have no crystal ball, but we have one advantage. We generally, in most lines, not in all, but in most lines, we have to look ahead only 1 year. We only have to look at what's going to happen the next 12 months. And so that's all we have to figure out. It's tough enough, given all the crises coming together, but we can adjust. So we can have a judgment of what's going to come the next 12 months, and then we can adjust to the reality. But it's very clear that there are more adjustments required now than ever before in the insurance and reinsurance industry, and that really strikes me.
And here I thought you did have a crystal ball in the closet. Inflation is obviously a big issue, and on top of that, we have social inflation increasing a lot of verdicts and thus messing with the whole cycle. How are you sorting through all that? How do you deal with the fact that those are hitting the insurance industry simultaneously?
Yeah, so we are, when you think back last 30 years, so there was no inflation going on. I think we all got used to an environment that has no economic inflation. I mean, there were countries, pockets, but let's say for most of Europe, most of the US and so on, there was no inflation really over the last few decades. What we did have is social inflation. So the part where just we can see the verdicts being decided in courts growing very strongly and getting to huge amounts. So social inflation was with us. I think we are today in the third wave of social inflation. It's fueled by a very strategic alliance between litigation funders and plaintiff lawyers. That's new in this third wave. So litigation funders help the plaintiff lawyers to go after even bigger companies. And the two together have created a very powerful alliance and has created this third wave we are now in since, I guess, 2015 or so. And it's with us, and it hasn't stopped. COVID has stopped it a little bit because the courts have been down, but now it's back to where it was before. So we can see that going on, not just in the US, but certainly the US is the most powerful combination of these two partners. Then coming through COVID and the dislocation of the supply chain, and then definitely with the war in the Ukraine, we have seen economic inflation kicking in. So economic inflation creates really two impacts, and both are dangerous to the insurance industry. The first is that it makes all our claims more expensive. So if the repair of a house yesterday costed 100, tomorrow it's going to cost 110. So that's the simple impact it does have. So all the claims increase with inflation. The secondary impact of inflation is that central banks will intervene. And they will intervene to stop, actually, they want to stop this inflation happening. So they will increase interest rates, which actually starts to reduce growth of the industry and really put more pressure on the industry. And so the more the banks, central banks have to do that, the more the risk is that through this combination of strong inflation and rising interest rates by central banks, the economy can actually turn into a recession or stagflation. Both scenarios are not good for insurance companies. So it's really the combination of economic inflation leading to recession or stagflation that is one for us to watch. And certainly for every underwriter in these times, it's even more important to look at technical results more than ever, because we cannot count so much on the income side from the asset side.
Climate change obviously complicates things a lot as well. I've been encouraged over the last few years to see that some of the knee-jerk resistance to the idea of climate change has gone away. So it's an easier topic to talk about, certainly, than it used to be. But that doesn't make it any less of a problem for you. So I wonder how you think the insurance industry ought to cope with climate change, and in particular, why we need to look at secondary perils as much as we do need to.
So when you step back just a little bit, you look at climate change, you can make statements, but they're extremely important for the reinsurance world. So climate change does not have an impact on earthquakes, for example. That's important because it's a very important peril that we are covering. Climate change, so that's a natural catastrophe unimpacted by climate change. Climate change also, according to our studies, has a relatively minor impact on many of the prime scenarios that are of concern to us. Tropical cyclones in the US are impacted, but not massively. Storm in Europe, to give you just two examples, are also not heavily impacted. But you mentioned it already. There are some of the secondary perils, and there I'm talking everything around flood, everything around hail, drought, fires, bushfires. Those are secondary elements that are very strongly driven by climate change. So when you sit where I am as a chief underwriting officer and I'm providing cover to a property risk, I have to understand the different exposures and particularly the exposure to secondary perils. So why is it more difficult for us to actually understand secondary perils? Why have we been rather behind the curve, as we call it, over the last years, is that we have collected less data over the last years regarding secondary perils. So we actually have models, but they are not fed by the same quality of data compared to the major perils. So as climate change moved in, fueled, by the way, as well, by inflation and urbanization and all of these other impacts that are sometimes more important than climate change, but we can see climate change nevertheless happening. As this comes in, we have seen the contribution to reinsurance, insurance losses coming from climate change going up to 50% of overall Nat Cat losses. So it is therefore of utmost importance for us to improve the data quality around it, because when we talk about 50% of our exposures where we are not satisfied with the quality of data, then we have a real gap, and it's one we have to close.
Interesting. How about Hurricane Ian? We've written about how in some ways, the Atlantic hurricane season has been surprisingly small. There have been fewer storms, but Hurricane Ian was a massive one. And it seems like there are going to be some repercussions. What do you see that doing to the industry?
So when we went to Monte Carlo earlier this year, early September, if you just recall the messages around Monte Carlo, they were all around hard market getting harder. The messages in Monte Carlo from us, from Swiss Re, were very clear. We were unhappy with the results across the lines, but also in Nat Cat. And we expect prices to go up. We have seen this year, at the beginning of the year, for the first time since probably 20 years, that the demand has been growing more than the offer. So clearly there has been a widening gap this year between the demand and the offer, and we estimated it already at 10-20 billion of difference, which is very, very significant for our industry. So that's how we faced the world, so to say, our clients at Monte Carlo. What Ian has done, Ian has just given this another very strong hit. So Ian creates even more pressure. So all those investors that were already spooked by it, they continue to be spooked, but many investors that were hesitating to invest still in Nat Cat have been very much discouraged. And we have seen even more capacity leaving the industry. And we think the gap that we will face next year could be as big as 40 or even 50 billion capacity, which is monumental.
Wow.
And therefore you can see, right, when you see that us reinsurers are coming out of 6 years of very mediocre results. So the desire for us to improve the rates and the conditions around our contracts to do that next year is very high. And obviously facing this dislocation between demand and offer, there will be certainly a lot of pressure on prices to go up, retentions to go up for next year. So it's going to be, I think, a very challenging market for everyone, so including our clients, of course.
Wow, I had no idea it was that bad. I knew that that it was a hard market and that Ian was a 2x4 to the head of the industry, but that's quite stark.
And don't forget, Paul, when I say the 40-50 billion gap, it's not that 40-50 billion capacity left the industry. I have no number, but let's assume half of it left the industry, 10, 20, 30 billion. The other half is inflation, right? So if you're an insurance company, you have to increase what you buy by 20, 30% just to catch up with the inflation. So that additional demand is the other 20, 30 billion. And there is no offer increasing. As I said, the offer is reducing rather than growing.
Supply chain is another one that I think about a lot, partly because in my career with the Wall Street Journal and with some other things I've done, I've followed industry for a long time now. And there's been a lot of offshoring in the name of efficiency. And I think that that 30-year trend or whatever it's been is not just reversing in the short term, but is reversing in the long term, because people are seeing what happens when you rely on Russia for natural gas in Europe or whatever. So I guess I wonder, first, whether you agree that it'll be a long-term trend, and second, how you think insurers need to adjust to this trend, and just why you think the trend is so important.
It's exactly as you say, Paul. We can see live the disadvantages of the globalized supply chains we have established over the last decades. I think the globalization has allowed us to be extremely efficient, keep prices low. That also explains partially the efficiency and the globalization of our industry and supply chains explain why the inflation has been so low these decades, isn't it? Now we actually see a turn in that. It goes the other way. So people can now see the impact or the sensitivity of our industry to these supply chains. So they can see that supply chains can be impacted in different ways. It can be a net cat event impacting the supply chain. It can be a war. Obviously, we see the huge impact of war. It can be COVID. It can be a lockdown scenario in a particular country. As we see it now, China, as you know, is a very important country in the global supply chain. So the lockdowns there leads to further delays. I think it's a long-term trend. It's not gonna. What is going to happen is that some of the globalization will reverse. There will be some nearshoring happening again. A new logic will establish itself. Prices will go up because nearshoring certainly will cost more, because otherwise, why would we have globalized before? So all of this will come through higher inflation. So it's going to therefore fuel inflation longer than we think. It's not the only driver, as I said before, but it does have an impact. There's one thing that I wanted just to say to make the link maybe, or the bridge to insurance. So of course, I said inflation is fueled by this return to nearshoring. The other impact it has is when you had a business interruption, like a machine breaks down in Germany and the machine, whatever piece has been damaged, comes from Canada, let's say. Before, it would have taken 2-3 weeks for that piece to come. It would have been readily available and it would be shipped to Germany, replaced. Today, it's not available anymore. They have to produce it because they depend on producers in other parts of the world, right, due to this global supply chain. So business interruption loss that was 3 weeks before, now it's 3 months, or 6 months or 9 months. So it costs considerably more, and it puts a considerable stress on every company in the world that has such claims. So you can see that not only insurance companies are challenged by much higher amounts to pay, but also the industries are challenged by this inability to serve their clients. And as people shopping, we can experience that every day.
I've always been amazed at the complexity of some of these supply chains and some of the hidden factors in there. I remember 10, 12 years ago, I spoke to a group of CEOs of pretty good sized Silicon Valley companies, and they were all amazed because they hadn't realized that they all relied on the same 10-cent part in their personal computers, and that 10-cent part they all came from one factory in Thailand that had been taken out by a flood. So they were sort of sitting around the room all commiserating because they were all in a world of hurt because of one little part that they just didn't realize was vulnerable in the supply chain. So
and
anyway.
It's a very good, very, very good example, Paul, in terms of risk management. Again, I won't blame any company in the world for bad risk management, but it is true that many companies had to realize over the last few years that actually they don't understand their complex supply chain enough. And therefore, they do actually not understand enough the dependency on such producers, single producers. And certainly what we see with our corporate clients is massive investments in the space of supply chains through technology, for example, to actually get a much better handle, understand these dependencies much better. So in terms of risk management, this has been a wake-up call, but I can tell with certainty that in the next few years, the improvement in terms of handling this supply chain will be massive. And as a result of that, in the longer term, there will be a globalization again, I guess, unless geopolitics don't revert to something more positive, then that obviously would be the blocker. But if that normalizes, globalization will start again in a much more controlled way.
Right. The hypothesis I've had for a while is that reinsurers have an advantage over insurers in some ways because you don't have the complexity of the distribution network. And I wonder first if you agree with that hypothesis, and then second, how you think about innovation in general, because in addition to the hat you wear as the chief underwriter, you're also the chairman of the Swiss Re Institute, which focuses on innovation.
So I'm not in the insurance space, so I would find it very arrogant of myself to tell our clients how to do business. However, there's absolutely truth in what you say that when you have an existing, as an insurance company, you have an existing distribution network, generally agents, brokers. And if as an insurance company, you want to develop your digital channel, you need to develop specific products that actually are better suited to that channel. And typically those are simpler products that require less underwriting. And there indeed, we observe with our clients quite often the challenge that the broker and agent channels actually have a concern, right? That this third channel is being developed with specific products. And so that certainly appears as a bit of a blocker, but I can see how companies overcome this because of the sheer necessity to serve the digital channel, to reach a broader client base that otherwise cannot be reached anymore in future. So I think as reinsurers, we have a bit of an advantage there, that we indeed not bound or limited by our distribution channel. We can think about these things differently. Also, we have usually a global view and can pick a product somewhere and develop it in a similar way somewhere else. So we do indeed have that capability, and also at Swiss Re, in the Institute, we do a lot of that innovative thinking around products with different features, but I think a lot is happening in the digital space. I think the risk we are having as reinsurers is the typical ivory tower problem, so that we develop this amazing product that nobody can sell, or it doesn't sell. And that's where the collaboration is absolutely necessary with our clients. But I do believe there's been a lot of movements in the last years, and I can see much more integrated sales where an agency channel and the digital channels are actually combined to actually build on the strengths of each. So not have only an either-or situation for the clients, but a fluid situation where a client can go from his phone or her phone to an agent and back to the computer, and it always works seamlessly. That's really where I see the most powerful improvements with some of the insurance companies out there, and the consumers will profit from this ultimately.
I sometimes tell people I've been watching the same movie for 35 years now, since I started covering technology for the Wall Street Journal back in the mid-'80s. And it's sort of the same movie. It's always kind of messy, but I am encouraged because I do see things happening, maybe not necessarily the way some of us expected 5, 6, 7, 8 years ago, but they're certainly moving. And I thank you and others for driving a lot of that innovation. Along those lines, maybe just one last question, and then I'll let you go. AI has been an intriguing one for a long time. People seem to vacillate between thinking it'll solve all problems and thinking it'll solve no problems. How are you seeing that play out in underwriting, and where in general do you see the potential impact for that in the insurance industry?
So the insurance and reinsurance industry is a data-led business. And so analytics, data has always been the basis of what we do. So it feels only very natural to me that in the long term, AI, machine learning will take a considerable space, and it will enable us, I think, mainly a few things. One is it's going to help us to do things more efficiently, by recognizing certain patterns. It will be able, or recognizing certain languages, semantics, and so on, right? It will help us to do certain works much more efficiently than we have it today. It will help us to remove the boundaries of insurability, things that today are not insurable because we can't make sense out of the data. We don't get enough of the data, and can be solved with models that will be enhanced by artificial intelligence tomorrow. So the boundaries of insurability should be moved. So those would just be two examples, but there are many more. One, for example, so there are many more. That's going to be in the long term. What I see today, right, is actually more of a hype. I know that lots of people are talking about it, like you, for decades. In this space, I've been hearing this like the radio AI, right, all the time. But when we're honest and assessing where we are, it's actually very little that is pure AI today and being applied. I can give you one example that I've seen in the industry working quite well. This is the accident detection. So when you drive your car, you have an accident, and if it's not, so they have technology in the car, sensors in the car, telematics that provide immediate data to the insurance company. And you can take a few pictures of your car. So and you send them to the insurance company. So at the insurance company, they can, through your pictures and through the telematics data, how fast have you been stopped driving, and how have you been stopped, and what has moved in the car, where did the hit come from? And with the pictures, they can actually get a pretty good picture of your car, and up to claims of $1,000 or so. It enables now very few companies only, but a few companies can now settle a loss immediately. So you send the picture, they got the telematics already, and maybe sometimes they just live off your picture, and you have the money on your account by the time you're back home. That's only possible by AI because they can check, right, all these pictures and real losses to check them against experience that they see. So that's working today already. But other than such very spurious, not spurious, but few examples, I can't see it being used widely today. At Swiss Re, we are developing AI, but very at the beginning. So I really don't want to say there's anything usable today, but we are developing it, and we think it's going to be available in, let's say, 2 years in the space of contracts. I was mentioning semantics before, so is enabling a program to recognize clauses, particular semantics, particular sentences, and make sense out of certain wordings, right? So rather than human beings checking every clause, we would like to enable a program to do that work instead. It's quite demanding, and it's but it's obviously one area we invest a lot in. There's also the life and health underwriting. You know, you have all these doctors scribbles when you go and see the doctor, or he takes notes with, or she with the computer. All those reports could be collected, read by a system, and with some good handwritten recognition of handwritten text and other intelligence. Actually, I can imagine a future where such underwriting can be entirely automated. We have tried it 2 or 3 years ago. We have failed. We'll try it again.
My handwriting is so bad, my dad told me I should have been a doctor. But
it's interesting what you say, Paul. So this handwritten, so the ability to recognize handwritten stuff of certain programs is today bigger than the one of humans. It's not bad.
And that's certainly my experience with innovation. It tends to start with a big idea, but then take a while to grab hold, and then it grabs hold in these specific use cases where you can do handwriting, you can do the first notice of loss and that sort of thing. So, and I tell people that insurance is as digital an industry as there is. I mean, finance fits the same mold, but anyway, I think there's loads of opportunity. So this is great from my standpoint. I appreciate your taking the time. I certainly feel like I learned a lot. Are there any final words you want to leave us with?
Maybe just a bit of an outlook. I mean, we are in a crisis, multiple crises hitting us. I feel so far the insurance and reinsurance industry has raised to its promises to actually help the societies to be more resilient. I really think, despite all the negatives I sometimes read about the insurance companies, we actually have paid billions of losses these times and helped companies, communities, people, families to get back on track. So, and you know, I think we're all very committed to this cause.
I agree. I think it's a shining moment for the insurance industry. So thanks very much. I encourage people to follow the work that you and your colleagues are doing at Swiss Re. I hope people will watch not only this interview, but the others we're doing in this series, and then check out the very interesting sessions at the Global Insurance Forum that the International Insurance Society recently put on. So thanks.
Thank you, Paul.